All right, good morning and good morning to everybody. We're starting the recording. We're going to start and we're going to be speaking with Ruth Benjamin this morning from Financial Tax Strategies. And we were just talking about, I put a little blurb in the bulletin this month about the Allure, which is a new upscale senior living community in Santa Clara. And we're going to discover some strategies to overcome capital gains objections and other types of objections with our homeowners. So I'm going to introduce Ruth, and thank you so much for being here. Thank you. Go ahead.
All right, you're welcome. I'm going to share my screen for my presentation and screen. Okay. All right, so what I'm going to do is I'm going to talk about the 1031 first, and then an alternative that uses 1031 but gets you cash. So again, I'm Ruth Benjamin, and I want to thank you guys for having me here today. But under the 1031 exchanges, did you know that 40% of 1031 exchanges fail? And what a 1031 exchange is what we're going to talk about today, how it works, and the requirements for successfully completing a 1031, and the crazy rules that go along with 1031, the common mistakes that we see clients do that causes them to fail, and what to do when your exchange is failing. If you're using the right accommodator, there's a couple different ways to do that. So we are that accommodator that can help out. I am not the accommodator company, but they are a sister company of ours that I help them getting the clients through. I call myself the customer success manager of the 1031. So this is for anybody, any real estate professional that wants to provide additional value to your clients, selling residential or commercial property with the intent to purchase more property or not. Okay. And for financial advisors or tax professionals that want to ensure that your clients choose the right accommodator. So let's imagine you decided to use the 1031 exchange to sell your property and purchase another. You do everything right. You follow all the complicated rules and meet the deadlines. Your exchange still fails and you're stuck with a big capital gains tax bill. I see this all the time. Exchanges fails, but it doesn't have to happen. My name is Ruth Benjamin. I'm a capital gains tax strategist. I spent 22 years as president of two different title company owned accommodator companies. I'm currently the customer success manager of National 1031 Exchange Services. And it's now 10 years at least 10 years that I've been working with other strategies when 1031 is not the best fit. So we're going to start today talking about the 1031 code. So the 1031 code is section 1031 tax deferred exchange represents a legal strategic method for acquiring or selling like kind or qualified properties in order to defer your capital gains tax. Now, if you meet the prescribed criteria as established by the IRS, then you can defer your tax bill by exchanging properties. Now, 1031 exchanges have been around and people were doing them since 1921. It wasn't until 1979 that TJ Starker sued the IRS and won, and that's how we got IRS section 1031. So one of the main things I get questions on is you have to buy like kind. So what is like kind? So like kind can be exchanged with any other property that's held for business or investment purposes. So if you had a single family rental home, not your primary, a single family rental home, you could sell that property. You could purchase a condo, industrial buildings, golf courses, retail spaces, farm and ranch, hotels and motels, and leases with 30 years or more remaining. I bring up the lease factor because if you're buying a property, let's say in Hawaii, and the property is a leasehold estate, you have to make sure that the ground lease has 30 years or more remaining on that lease, or it's not considered real property. So be careful with any type of leasehold estates. Your single family rental, you could buy multifamily rentals, offices, land, and tenants in common. Now remember this tenant in common, because later on down the road, I'm going to be talking about tenant in common with our other strategy that I want to talk to you about today. And it can be Delaware statutory trust. The type of properties that are not like kind is your primary residence. You're using it for your personal use, not business or investment use. Second homes typically don't qualify, but later on in this presentation, I'm going to show you how to get them to qualify. And then flippers and developers. 1031 is not your strategy. If you do too many of these, the key is the intent to hold the property for business or investment use. Flippers and developers, you guys are buying properties to get rid of them. So you might get away with 1 or 2 per year, but don't do too many of them. I have other strategies that could help you get rid of the tax bill. Now, REITs, they're typically a membership interest in a trust and are not exchangeable unless the REIT is considered real property and not a partnership interest. So you can exchange anywhere in the United States, okay, including US territories. So let's just briefly touch on the reverse exchange. The reverse exchange is where you buy your new property first. Typically, you either have the cash to buy the new property or you get a new loan. And we, as the accommodator, take title to the new property, or we can take title to the one you currently own, depending on the circumstances. So we create an EAT. An EAT is an LLC that we create specifically to take title to your property. And the key in a reverse is you must sell your property within 180 days. And the safe harbor reverse is the safest method. Safe harbor simply means the time period the IRS gives you, which is 180 days. Now, there are some companies out there, if you're using attorneys, that could do out of safe harbor that take a longer period of time. But the cost for reverse exchanges range from $6,500 to $10,000 or more, depending on the situation. The benefit of the reverse exchange is you can close on your new property without worried about your old property selling, and you don't have to worry about the 45th day time period because you already know which property that you're going to sell. The drawbacks are that you have to acquire that new property without the benefit of your sales proceeds, right? So if you need to get financing from the banks don't like that you qualify for the loan and our LLC takes title. So in that case, we just take title to the one you own and you take title to the new one. We have to structure it a little bit different. And we may require an environmental report, but typically not for 1 to 4 unit residential properties. So then I want to just slightly touch on the build to suit exchange. The key thing here is you cannot build on property you already own. Okay, you must. So when you're doing an exchange, and if you own a piece of land over here that you want to sell a property to build on that land, don't do it. It's not going to fit in 1031. What the IRS wants you to do is go buy a new piece of land that you don't have title to, and then take the identify the property with the improvements. The improvements have to be done by the 180th day, and you must have an occupancy certificate. And it is possible to do a reverse 1031 exchange. So I've never really seen a build to suit exchange completely successful because it's too short of time to get the work done. But when people say I'm going to do a 1031 exchange, they're typically talking about the standard delayed exchange. So I always tell clients, talk to your tax advisor, make sure that there's not any losses they've had in the past that could offset gains. Once they get that approval from their tax advisor, list the property for sale. And then once the agent gets the contract with a buyer, then they open escrow, right, with the title company, or if you're on the East Coast, the attorney's office. And then at that time is when you want to open the exchange with the qualified intermediary. Now, be aware, as a real estate agent, there's verbiage in the contract that needs to go in order to show your intent for the 1031. So I do have that verbiage that I can provide to you. Some contracts already have it built into it, so we just have to see what you're going to use there. So the exchange company will prepare the exchange agreement, send it to the escrow to be signed by the seller and the buyer. Once the transaction closes, you have 45 days to identify the replacement property, and you have up to 180 days. Now, a delayed exchange could be done for as little as $500. It depends on the sales price of the property. So it's, and then it gets up into the $1,000 when you get up into the millions, and it's prorated from there. So the basic 1031 rules, if you want to defer 100% of your capital gains taxes, let's say you're buying a property for $1.8 million, you need to buy a new property or properties combined value of $1.8 million. If you have $1,125,000 in equity, you have to roll all that cash to get 100% tax deferred, roll it all into the new properties. And if your loan balance at the time of sale was $675,000, then you need to get a new loan of $675,000. So equal or greater in those three areas. Now, if you want to defer some tax and pay some tax, then that's called a partial deferred exchange, right? So if you sold a property for 1.8 million and you bought one for 1.4, but you did roll all that equity into that new property, and your loan ended up being 275 versus 675. So now the IRS is going to say, all right, you have a trade down in two areas, on the sales price, because you went lower, and the loan. And what the IRS does is they're going to tax you on the larger of the two areas. They won't tax you two times. They're just going to tax you on the larger of the two trade down areas. So once you close on your property, you have 45 days to identify properties and 180 days to close. So again, here's the identification period. After the 45 days, you have 135 days left to choose one of the properties that you identified. And if you want to combine a couple properties to do that, if you want to sell two and maybe buy a larger apartment complex, you can do that, but the time period starts on the first property that was sold. So the identification rules, the most simplest rule is the 3 property rule. Just simply identify 3 properties, and you don't have to worry about values or anything like that, but you do have to make sure you meet the equal or greater in sales price, right? But if you identify 4 or more properties, then you hop into the 200% rule that says that you may identify an unlimited number of properties, provided that the total fair market value of all the properties identified doesn't go over 200% of the fair market value of the property you sold. So what does that mean? If you sold a property for $1 million and you identify 4 or more properties, all those properties that you identified, add them up. Okay, what are the asking price? Okay, you can't go by what you're going to offer to them. You want to go by the asking price, the fair market value. Add them up. As long as all of those combined do not go over 2 million, then you're okay. You could buy 1 or 2 or however you want to mix it up. But if you go over 2 million, then you're kicked into the 95% rule that says now you have to buy 95% of that combined value of everything you added up. So you're going to end up buying pretty much all of it if you use the 95% rule or go over the 200% rule. So be careful with that. Now, the identification must be made in writing and use a distinguishable address or a legal description, and you can identify to any party that's a part of your transaction, but not the real estate agent. So if you have an attorney or basically attorneys are the only other ones, we're going to want a copy of that identification because we want to know that we're able to move forward without any problems. So the suggested holding period, and I'm saying suggested, this is not in the IRS code, but all of the technical advice memorandums and the private letter rulings that come out, the IRS likes 2 years. 2 years to hold before you sell, 2 years after you buy. But we're in California. Most of us are in California. There is some case law that says 6 months. Okay, so if you want to be safe, I would say at least a year when you're buying in, at least a year. If you bought it outright and didn't buy it in an exchange, then you want to hold it for at least a year before you turn around and sell it again. All right. Another thing to watch for is related parties. So you cannot buy from a related party unless the related party is also doing an exchange. So when selling to the related party must hold the property for 2 years or it disallows your exchange. Let's break this one down. You have a piece of rental property. You sell it to your brother. You sell it at the fair market value. You go and find a replacement property. You identify it by the 45th day. You acquired it by the 180th day, and you did everything right. Well, if your brother sells that property before 2 years, then your brother will disallow your exchange. Okay, so you've got to be extremely careful that they understand not to sell that property for 2 years. All right, so related parties are brothers, sisters, spouses, ancestors, and lineal descendants. They do not include step parents, uncles, aunts, in-laws, cousins, nephews, nieces, and ex-spouses. All right, so watch out for the community. And we are in the community property state here in California. And I believe there's about 7 or 9 community property states. So anybody that has corporations and LLCs and you own more than 50% of the stock or the membership interest of your entity, and you want to sell to your entity, you have to be careful of the related party rules with that. So anybody that runs into that situation, reach out to us and we can help you out with that. So the other crazy rules are if you take any cash out of your transaction, they call it boot. A boot is just a term for a taxable event. So if you take cash out, you're able to do that, but you're going to say that you have to pay tax on that money. So let's say that you want to pull $100,000 and you call me up and you say, Ruth, I'm going to take $100,000 out of this property and I'm planning on paying taxes on the 100,000, but I want to defer the rest of it. Great. So you go ahead and take the cash out. Now, what happens is if you pull the cash, then you're going to pay tax on it. If you bring the cash in later, you can't offset the tax. So let's say you found a piece of property that you closed your transaction, you took 100,000 out, and now you found a piece of property you absolutely love. Maybe it's on the water and there's a boat out in the boat slip out there, and there's nice car in the garage, and you have a fully furnished house. Then if you need to bring that 100,000 back into the transaction, then you're going to end up still paying tax on the 100,000 because you just don't want to pull it out unless you absolutely know that you're not going to use it. Okay. So if you wait till the end of the transaction, then there's rules we have to follow, and I'll touch on that on the next slide. But let's say in my example, you had a loan for 675,000, but then you said, I don't want to get a new loan. I'm going to bring $675,000 of cash into the transaction. You absolutely can do that. Okay. But remember, cash boot cannot be offset. So if you buy that house and you want to bring money back in, then you're still going to pay tax because you touched it. That's the key. Don't touch it. So a lot of times people say, well, I'll wait till the end of the exchange. Well, there's rules accommodators have to follow. All accommodators have to hold the funds until midnight of the 45th day or midnight of the 180th day, or it invalidates your exchange. So if you identified, let's say 3 properties. No, let's go back. You identify 1 property and you bought it. And now you have money left over and it's the 45th day. We can wire the rest of the money to you on the 46 days because you only identified 1 and you bought that 1. But if you identify 2 or 3 and you only buy 1, and then you call me up and say, hey, I want my money, then I have to wait till the 180th day because there's two properties on your form that you didn't buy. So there's some sticky situations. And if you close on the exchange, let's say it's day 30 and you call and say, no, I want my money. It's my money. I want my money because I'm not going to buy anything. I'm not finding anything out there. I'm just send me my money. We can't send it till the 45th day expires so we can wire on the 46th day. This is all accommodators. So please don't get mad at them when they tell you that's how it works, because the IRS puts strict rules on us. And we don't want people to get upset. We want them to know in advance what those rules are. Now, we talked about primary residence not working for 1031, but you can convert a property to a primary residence. So if you have a 1031 property and you want to move into it to get the exclusion, let's talk about that. So you must own each of the relinquished property and the replacement property for 2 years. Then when you go to sell that primary residence that you moved into from a 1031 exchange, you must be on title for at least 5 years. So the longer you live there, the bigger the proration gets. But you will never get away from the depreciation recapture tax from the time that you had it as an investment property. So let's assume married taxpayers exchanged into a single family residence, rented it for 3 years. Now they moved into it and lived in it for 2 years. So if they sell it, they're going to have a realized gain of 500,000. So the exclusion would be prorated between the qualified use and the non-qualified use. The numerator is the period of non-qualified use and the denominator is the number of years the property has been owned. So 3/5, 3 out of 5 years that you really had it rented out of the gain, which is 300,000 in this example, would not be eligible for the exclusion. But the 2/5, the 2 out of 5 years that you lived in it of the gain, which is 200,000, would be eligible for the exclusion. So people that are moving into their homes thinking, oh, I'm going to get $500,000 tax free every 2 years, that is false. That doesn't work. You're only going to get the prorated version. So as a consequence, the taxpayer would pay tax on the 300,000, the rental part, plus the depreciation recapture tax. Now, if you have a primary residence where you rent out a room or you have an granny unit that, ADUs, then great. You can sell the primary and use partial 1031 and the 121 exclusion. That's not a problem. I had a client that ran her business out of her kitchen. It was a doggy bakery. And so she was able to allocate that much, the kitchen portion, into 1031 so she could actually go buy another investment property with the 1031 portion and lower the tax bill for the 121 exclusion. So I told you earlier, second homes don't qualify, but we're going to show you how to get them to qualify. So you must have owned at least 24 months immediately before trying to exchange a second home. And in each 12 months prior to the exchange, you have to have had it rented out at least 14 days. And you must have not used it for your personal use more than 14 days or not more than 10% of the time you had it rented out. So if you had rented that second home out for 300 days in the year, you can use it within 30 days and still do the exchange. Now, the beautiful thing is working weekends don't count. So if you go to the property, you can say, go to the local hardware store and get a receipt, right? You can say that you are working on the property so it doesn't count towards your 10% of the time you have it rented out or the 14 days. Now, partnerships are really tricky when it comes to 1031 exchanges. If you own a property in a partnership and the partners all want to go their own way, you must dissolve the partnership 2 years before you can exchange the property. Or one of the partners can buy out the partner who doesn't want to move on with real estate. They just want their money. And that way the partnership can go ahead and do the exchange as the partnership. Now, the IRS does not like drop-in swaps. Drop-in swaps is, let's say you have the property in an LLC. The LLC has its own tax ID number. So if you deed, the drop means a deed. If you deed that property from your LLC to your name and your social security number and your partner's name and social security number, now you have the same problem that developers and flippers have. You didn't hold the property for business or investment use under your individual name. So that's why I make the claim so many times that exchanges fail when you don't even realize that they fail, okay? So the same taxpayer who transfers the relinquished property must acquire the replacement property, but there's some favorable exceptions. A disregarded single member LLC and the sole member is one and the same. A grantor and the revocable living trust is one and the same. And if a taxpayer dies during the exchange, his or state or trustee may complete the exchange. And does that happen? It absolutely happens. We had one that just happened the last few months or so. So let's give some examples. If you're selling as an ABC partnership, you must buy as ABC partnership, same as the corporation, buy as the same corporation. But if you have a revocable living trust, the Smith Revocable Living Trust, and then you go to buy your replacement property and the lender says, we don't loan to trust, it's okay to take title as James and Sally Smith as individuals, and then later on you can move it into the trust. Now, John Jones sells a property, but John Jones says, you know what? I need some asset protection. I'm going to create an LLC. As long as John Jones is the only member of that LLC, then it's okay. Now, anybody in a community property state and wants to add a spouse, it's okay. So the community property states are listed here. So you won't have any issues. Anybody that lives outside of these community property states, you'll want to check with an advisor. Now, if Sam Smith sold 100% of his property, and let's say it was worth 300,000, and then Sam Smith and goes and buys 20% of a TIC, which is a tenant in common, that's okay. Sam Smith is able to do that, but Sam Smith's 20% needs to be in Sam Smith's name, and that value needs to be 300,000 or more. So like I said before, remember the name TIC because I will be bringing it up again in just a little bit. So seller carryback notes is happening a lot in this market. That's where the seller's carrying the financing for the buyer or a portion of the financing for the buyer instead of the buyer having to go to the bank. They might not be able to get all of their financing from a traditional bank. So you can do the seller carryback in a 1031 exchange. Typically, the note is made payable to the accommodator, and then the client has up to 180 days to sell that note to somebody, or you can ask the seller of the new property you want to buy to take the note as part of the down payment for that purchase. And it sounds a little crazy, but believe it or not, sellers do it because they don't want to pay taxes either. Or you can sell it to a third-party note buyer. But remember, if you discount the note, then you're going to pay taxes on the discounted portion. And if the client doesn't get it sold within the 6-month time period, the accommodator assigns it back to the client, and then the client starts accepting the monthly payments on it. So any portion of the principal of the payments will be capital gains, and then the interest portion would be taxed as ordinary income. When you finish your exchange, you file Form 8824. That form wants to know what did you sell? What did you buy? Did you identify it by the 45th day? Did you trade equal or greater? Did you acquire it by the 180th day? That's the form that you would put everything on. Most CPAs are very familiar with this this form. And if you have an exchange that closes after October 17th of any year, between October 17th and December 31st, if you need your full 180 days, you want to file an extension on your tax return to make sure, because April 15th falls in that time period. So if you need your full time, don't file your taxes yet. Wait till your exchange is finished. So now I want to talk about 15% incidental rule. So 15% incidental personal property can be acquired with exchange funds for part of the purchase price of the new property without putting the exchange at risk. But to the extent you use exchange funds to buy personal property, you're going to get taxed on that portion. But be careful not to go over 15% of the real estate value for personal property, or it can invalidate the whole exchange. So let's go back to that home that has the boat out there in the dock and a couple cars in the garage, and the property is all furnished, right? So when you're buying a property like that, make sure you have a separate contract for the real estate portion versus the personal property. Because if you don't, and all that personal property goes over 15% of the real estate price, then you can invalidate the whole exchange and end up paying taxes on everything. So what I always suggest is to keep a separate contract for the personal property than the real property. And think about this, you guys. If you're having, let's say you have an apartment complex that's selling, the sellers typically keep the rent deposits in a separate account. So what happens if they don't go to that bank account and bring it into the escrow, then what happens is if they don't bring it in, and they use the net proceeds to give the money to the buyer, then the IRS is going to call that boot. They want you to go to your bank account, bring those rents and deposits into the escrow, and have that money given to the buyer. So don't take it out of their equity. Make sure they bring that money in. So besides in choosing a qualified intermediary, besides the strength of the intermediary, make sure they're bonded and insured. We are bonded and insured. It's like choosing an escrow officer or a real estate agent when I'm talking to clients that does good work for you. Who answers the phone? Who responds to your emails and can answer your questions and has a creative mind to help you get deals closed. And that's one of the things I pride myself on. And I always believe if there's a will, there's a way. Let's figure this out. And in cases where I need help, we have attorneys that are ranked in the top 10 of the industry, and one of them had participated in getting laws written. Okay, so now let's talk about Plan A or Plan B. We have a product that we call liquid 1031 exchange. So if you have somebody that's really tired, they just don't want to stay in debt, they don't want to deal with tenants, and maybe they're not able to qualify for a new loan doing the 1031 because maybe they're retired, right? So this strategy allows them to sell their property, exchange into this product, and end up with cash. So let me show you how this works. You sell your property, your relinquished property, in the standard 1031, right? Sales price, equity gets rolled over, new loan, identify the property within the 45 days, buy it within the 180 days. Same thing, the accommodator will prepare the exchange agreement. Everything is exactly the same. The money goes to the accommodator, the debts get paid off, and the net sales proceeds sits with the accommodator until you're ready to buy your replacement property. The replacement property is our TIC product. Remember earlier I said TICs qualify for 1031. So we would determine how much you want to buy of this TIC product. So we get that all figured out, create the purchase agreement to buy the TIC. That is your replacement property in your exchange, is to buy that TIC interest. So when it comes time to close, the title company that's going to close the purchase of your TIC, then they request the money from the accommodator to get this accomplished. Here's the key. Once you close on that TIC property, you bought it, the clock starts ticking. After 2 weeks and a day, you have an option to refinance your TIC interest and pull out 93% of the cash in the form of a loan that has no payments for 30 years. So the cost of this strategy is 7% of the net sales proceeds before any loan is paid off. And then 30 years from now, you will decide if you want to keep that TIC interest. They're going to build on it. It's raw land right now, but you get to decide, do you want to keep it and pay back your loan, plus the interest and a development fee, or you can simply deed your TIC interest back to the TIC company and the loan is extinguished. So if you happen to pass away in the next 30 years, your family should receive step up in basis, so the tax bill goes away. Then your family has an option to deed it back to the TIC company and the loan goes away. So your family will be jumping for joy that they don't have a tax bill. So the money flow again on this strategy, you sell your property, funds go to the accommodator wires the money to purchase the TIC interest from the Sand Hollow TIC is their name. The cost of this is 7% of the net sales proceeds before mortgages are paid off. And when the title company closes the deal, they send the money to an attorney's trust account while you're waiting for that 2 weeks to get that refi. A third-party attorney firm is holding that money. So when you're ready for your loan, you know that money is sitting there waiting for you to be able to get that loan. So a typical time period between the time you sell your property till the time you get the cash is about 40 days if we move quickly on everything. So that strategy, I love it because your CPA is putting on your tax return that you did a 1031, which you did. But there's nowhere on the tax form that says 2 weeks later you refinanced it and pulled out cash. So I love this strategy for that reason. If you have anybody that wants to sell a primary residence or one of those properties, the flippers or developers or anybody with that, we have a charitable holding company that can eliminate 99% of your tax bill. It uses charitable entities that the charities don't get paid for 30 years. We also do offer tax deferred cash out. That one is for business sales and mainly for business sales and investment property and in some cases, primary residence. That one gives you a 30-year tax deferral, but after the 30 years comes up, you do have a tax bill. We also have trusts. They are non-grantor complex trusts. If you want asset protection, which means somebody can sue you, get a judgment against you, and you still don't have to pay them. If you want that kind of asset protection, which I believe everybody should have it, there is a way to put your properties into the trust today, and in 2 years, you can sell them and defer your tax bill for 30 years. So those are other things that we can do and talk about at different times. But here's my information. If you want to talk about a client or you have a situation for yourself, these are all free calls. Just get on the calendar, let's talk about it, and you can decide which strategy fits best for you. So I covered a lot of information, and you guys can ask questions or you can schedule a call with me.
Yeah, I've got 2 questions if I can do it.
Yep.
The 7% in the TIC, is that a requirement or legal? Where does the 7% come from?
The 7% is their fee. So when you're pulling out 93% of the cash, you're keeping 7% in the project.
But what I'm saying is that something that's legally required, or did they just negotiate the 7%?
It's the way they set this up. It's just the way they set it up. It's not based on any, loan.
Okay,
Yeah, because the lender that gives the loan is a hard money lender, so they're not under like the
I understand. Okay.
yeah.
And the other thing is that you mentioned the REITs don't qualify in a 1031, but in a 721 they do. Do you use them at all?
Well, the REITs can qualify if they're considered real property and not a partnership. It really depends on how they structure the REIT. But so I just don't want you to say, oh, any REIT qualifies. You have to look at the structure of it.
Okay.
So is a TIC, is that a product comparable to a Delaware statutory trust, a DST? So
Yes.
it's an actual label, it's a branded product and you can choose?
Yes. So the difference between the TIC and the DST, when you purchase into a DST, you're going to get monthly income. Well, when you purchase into the DST, you have no deciding rights. You become a creditor to the DST. You have to go by what they do. And I've had clients that have called me and said, I bought into a DST. They promised me 8%. I only got 4%. I'm happy with that, but now I'm getting nothing. And you can't do anything about it. And you're stuck in it for, typically DSTs are 7 to 10 years. I have seen some at 5 years, but that's why I like the liquid 1031, because you're getting your cash and now you invest it, you have 100% control over it. And I'm one of those people that if I lose the money, it's on me, but I don't want somebody else losing my money.
So are there tick providers that are companies, say like Kings Barn is a DST provider. So is it kind of like that?
Well, it resembles that, but it's not a DST, but it is a group of people that own this. The property is in Utah and it's vacant land right now. So there's a few owners of that land. They own it outright. So they're allowing people to buy in and purchase the land. And so if you buy into it, you own the land only. But what they do is they enter into a management agreement with you that says they're going to build on your land. And during the time that they're going to be building on it, then they're going to take care of the property taxes, the insurance, they take care of everything. Now, you don't receive the benefits of the build out because you pulled out 93% of the cash, right, for your land. But if you want to take advantage of what they built on it, you simply pay the loan back plus the interest and a 5% development fee, and then you can reap the rewards of what they built on it. Now, at any time during this 30-year period, you can always sell your interest in the TIC. You can do another 1031. You can just sell outright. You have a lot of flexibility, but the key is you don't have to. If you want your cash, I had one client that went and paid off his primary residence. He was heading into retirement and he just said, I want to pay off my primary so I don't have to worry about retiring. You can use the money in any way that you want.
And is there more than one tick to choose from when you're talking to a family?
Right now, the TIC in Utah is the only one available. I have 2 other TICs being created at the moment. If they get to completion, there'll be an oil and gas in Santa Monica. It's land that has oil underneath. And then another one we're talking about is in Texas. So you just have to find out what's available. So don't let any of your clients sell their properties and go, oh, I'm just going to do the liquid 1031. You have to reach out to me first and make sure I have availability, right? I need to assign a portion to you so I know that your client will be able to buy into it. So don't do it blindly. Reach out and say, hey, my client is going to sell a property for $2 million and wants to buy 2 million of the TIC. Then I set it aside so that will happen for your client.
So who else is doing this, Ruth?
Well, this is my 2nd year doing it. So there's not a lot of people out there. It took us years to get the deal together with the right paperwork. You know what I mean? It took a long time. Now, I'm sure if somebody steals our paperwork, they can do it. But you got to find a lender that's willing to loan 93% of the money with no payments being made back to them. The only reason our lender is doing this is because they want to be a part of the full project. The project in Utah, it's going to be homes on the water. Now, there's no water in Utah, so this is very unusual. There's another project that they're mirroring, but one of the owners of the TIC is a farmer and they have water rights. So they're going to have a very unique product that they're putting in Utah, and this lender just wants a piece of it. So that's why the lender is loaning this money with no payments coming in, because they really don't care if you pay the loan back plus the interest or let them have that property.
And so the consumers, our homeowners, our clients, our people, when we were starting to talk to them, and if they do happen to say, oh, I heard about this TIC thing, how would they have heard about it?
Only by the presentations that I put out there and other realtors that are starting to talk about it.
I'm getting an idea on who the developer is out there in Utah. Anyway, that's for another. How exciting! How exciting! Bob has a.
Hi, Ruth. I have a
Bob has a
question.
question.
Oh, hey Maggie, how you doing?
Hey, I'm good. How are you?
Good.
First on the DSTs, the difference between a registered DST and an unregistered DST. And is there such thing as a registered TIC?
A registered TIC. Well, I know they had to do some registering when they put everything together, so I'm assuming there is, but I don't know the full details. They had an attorney create the tick.
The reason I bring that up, about the registered DSTs versus the unregistered DSTs.
Well, I didn't talk about registered and unregistered DSTs. All DSTs have to be regulated by the SEC. Otherwise, the other DST is the Delaware Statutory Trust that is not regulated. So one's a deferred sales trust is not regulated. Delaware Statutory Trust is regulated.
Right.
Yeah.
I mean, that's what I'm getting at, is that
Yeah.
when the issues with all these issues is who do they trust? And a registered DST adds a level of trust to the product as opposed to an unregistered DST.
Yep. Well, what we've had
And
clients.
the TIC market is newer. Some of the larger DST companies are doing some more TICs as well.
Well, actually, the ticks are older than DSTs,
Right.
but they weren't back in the day. They weren't running the tick companies correctly, so people kind of fell out of those and went DST. But we are about making the client comfortable. I had about a $4 million transaction happen this year. They sold in November, but their advisor said, don't take the loan till January. So there was almost $4 million sitting there that made them nervous. Well, the lender, what they did is they took the almost $4 million and placed it in the attorney's trust account with instructions that that money was not to be moved until January of the following year. So that made the attorney comfortable because we showed the proof and that the money was there waiting for their loan and they were able to move forward. So that's always a concern, but we can always address those concerns to make the client comfortable.
Go ahead, Maggie.
Hey, Ruth. Nice to see you. I have a question. So should a client come and consult with you prior to selling, or can they still consult with you after selling?
With this particular product, if they've sold and accommodator's holding their money, I can talk to them. So it's before the 45th day. On this particular.
Okay, because I just had a client who just had a all cash sale, and it's a lot of money, and he's worried now. So I think I'm going to send him your way.
Did he touch the funds?
No.
Okay, good. Yeah, because just so you guys know, I have solutions. If they touch the funds, they're not as good as if they, the before is better than after, but we have solutions in both ways.
Okay. Thank you.
Thanks, Maggie.
Does anybody else have any questions? Lynn, you always have questions.
I do, but it's been a little crazy on my end. I got two in contract and one of them is backing out, such as our market now with flighty buyers. So just trying to.
Sorry.
Yeah, no, it's okay. Trying to hold things together.
Virtual hugs.
Yeah, Ruth, nice to meet you. I'm Lynn. I like your approach. I think you're very clear. I'm wondering, you're a tax strategist, and do you work with, so I have a situation. I'm sorry to ask such a long-winded question, but one of my prior clients, I helped him sell his place in Sunnyvale, and his parents now have 4 properties that they inherited from the dad's grandma who passed away. Sorry. And so one of them is a primary and 4 of them are rentals. So we're interviewing for 2 of the properties, which are the rentals. And so they are thinking about doing a 1031 exchange because if they don't qualify for the step up in basis because they used that when the father passed away. If that makes sense. The father first passed away, they used the step up, and it's some, and then now the mom passed away, they can't use that anymore. Is
Wait,
what
wait. Why can't they use it? Because when they get step up from dad, they're only going to get grandma or mom would have received step up from dad's portion. And then when mom passes, the family gets step up for the remaining part of her portion.
okay, this is what he said. The houses were in a AB trust.
Oh,
The
okay. Now,
two houses had their step and cost basis when my grandfather died in 1990.
mhm.
Other houses were in the other part of the trust and did have a step up cost basis last September, but that's why they were looking into options for avoiding the capital gains. So are
But
these
they should still get the grandma's portion of step up. See, grandma got the grandpa's section went to grandma's step up. Now that grandma's gone, family should get grandma's step up. Not grandpa's step up, but grandma's step up. So it just means the tax bill might not be as high as they think it is.
Okay, so maybe I'm not understanding what A/B trust is.
Well, typically people have a living trust. And so when they create their trust, they create it as husband and wife in one trust.
yeah,
Okay. When they have an AB trust, husband has his own trust, living trust, wife has their own living trust. Okay, so they're each separate. And that happens a lot in second marriages, right?
Okay.
So because let's say husband wants his stuff to go to his children, wife wants her stuff to go to her children. So they
Yeah.
create an AB trust. So using an AB trust, they each say if we die, our portion goes to the other person, right? And then it'll flow to the kids after the death of the second person. So you have to kind of look at the trust, but doesn't matter what is happening. I would love to talk to your client to see if there's a large enough tax bill to do some of these things with. And what I want to know is what do you have and what do you want to end up with? And we help them get to those goals.
Oh, wonderful. Do you have a number here in the chat or?
It's right here on the slide.
Oh,
right
stop.
behind
Sorry, I see
That's
it.
okay.
I
And
took
my
a
email.
picture. Yes, wonderful.
And
Okay,
it's
yeah.
also on the bulletin.
Oh, okay, yeah. Thank you. I appreciate you, Ruth. And you are based out of Los Angeles?
My office is in Milpitas.
Oh,
I live
Milpitas.
in San Jose. I work from home 100% of the time because I get more done at home than I would in the office.
Absolutely. The office is too fun of a place and you get distracted. I understand. I'm the same way. So, okay, wonderful. Well, nice meeting you, Ruth. And yeah, I will talk to them and see if I know they said they had somebody they were going to be talking to, but if you have do you have deferthegainsTax.com? Is that your website?
That's our website. And
Okay,
people will say,
wonderful.
but I don't see everything on the website. You won't. Because
Okay.
I only put on the website enough to get someone to make a call with me. The
Okay.
reason is why would I hand to the IRS on a silver platter what the strategies are?
Right.
Not going to do it, right? So I
Right.
have a couple to get you to call me, and then we get to go through everything.
No, you
So
have to run your business. I
Yes.
understand. Yeah.
so basically what we do, let me see if I can show you here. I'm going to end my show here.
Mm-hmm.
See if I can find it. So when I have, why is it telling me I'm leaving a site? Okay, leave a site. I don't know where I'm at, but all right. So I'm going to share my screen one more time to show you what I
Are
do.
you available for consultations even for us just to understand everything and ask questions? Is
Absolutely.
that okay? And is there a cost to that?
Nope, no cost.
Okay, okay. I think maybe I should talk to you first before okay.
Yeah, so what I do when people call me is I pull this sheet up. I'll just show you. Oh, this thing wants to get in my way here. Let me bring it up a bit.
No problem. I think I'm going to book it because I have a call with my client and managing broker in a minute. So I'll go ahead and book on your calendar a time for us to talk.
Okay, So basically what I do is I go through what they're selling, what they paid for, all that, get a tax bill, and then these are all the strategies that I have available to offer them when they come through. Plus there's about 4 or 5 after the sale I can talk about. But in reality, yes, you can get rid of people's tax bill. And then people say, well, how come the rich don't pay taxes? Because the rich people can afford the cost of these strategies. If, if you're only paying $10,000 in taxes, but the strategy costs 50, it doesn't make sense.
No,
You
yeah.
see what I mean? So that's kind of, what I do. And my calls are all free. We're out on social media. I have people reaching out every day, just saying, hey, what's my tax bill? What do we do? And we just help guide them. Now, I'm not an attorney, I'm not a CPA, but I have the attorneys and the CPAs that back me. So if I need them, I pull them in. So I'm not doing any legal work where I shouldn't be doing that.
Thank you so much, Julie, and thank you so much, Ruth.
You're welcome.
You're welcome. You're welcome. Yes, amazing stuff. So much opportunity there for us to have conversations with our homeowners and our senior homeowners and the families of senior homeowners. Anytime we have, the number one objection is the capital gains issue. And so this just adds another, set of tools in our tool belt. And initially, so what we strive to do, especially as seniors real estate specialists, is engage with people like yourself that are the experts in that subject, whatever it is. And then we recognize it and we are able to have a conversation and refer our clients to the right professionals to get the right solutions. And so that these families, these homeowners can meet their goals successfully.
Right.
So we really
I
appreciate that.
like to be named as part of your team.
Yes, exactly.
I like you to say, well, there's Ruth. She's a part of my team. She helps you get rid of the tax bill. Why don't you talk to her and see where we can go from here?
Exactly.
I assume you work in other states?
All over the US. My business partner's in Maryland. So
Nice.
and he specializes more in business sales in that. So even if you have people selling businesses, we can get rid of tax bills. I just have a really great team behind me.
Where have you been all my life?
Would you be available at any time? Say we had consumer facing events to come and talk to a group of our homeowners, our clients, our databases?
Absolutely. So Maggie, I have a question for you. When somebody moves into a senior home, how long is it before they either have to sell the property or pay the regular reverse mortgage off?
It's 12 consecutive months for the last person living. If they're out of the home for 12 consecutive months,
so
that's when it becomes due and payable.
So if you got the family, when the person goes into a home, if you got the family to rent the house out, after the 12 months, we could do the liquid 1031 that would pay off the reverse mortgage.
Okay, that's good to know.
Mm-hmm. They just have to convert it.
Thank you for sharing.
Yeah, a couple of
thank you for sharing.
Evolved strategies on how we work with our clients to be able to afford to move into a senior living community and how to plan for that and how to amortize it for the entire stay that they're expecting and making the highest and best use of whatever proceeds that they experience with their property here.
Mm-hmm.
Yeah. Yep.
So it's just a thought, if you're trying to plan so many, sometimes they say, well, the house is sat vacant for a year. Well, if the parent hasn't lived in it, that's okay. It still qualifies. But if they actually turned it into a rental, even if they rented to a family member at fair market rent, it's still a rental. It's still something the client hasn't lived in.
Okay.
Amazing.
Good
Is
stuff.
anybody else? Go ahead.
Oh, and there's referral fees. I forgot to tell you guys. Every deal you bring in, there's a referral fee. So.
Well,
You should have started with that.
Yes. So-
Yeah, you had us at referral fees. Yeah.
Yes.
No, because it's just all about taking care of the clients and everybody's working hard to do the highest and best thing
Yeah,
for the families and their real estate. So that's what we do.
exactly.
That's true.
That's it.
And then we get the bonus of being able to live, right? That we can make enough money to live on and get by.
Well, here's the other thing too. All of this is stuff for us to know, of course, for our clients, but for us in the first place. Skip
Mhm.
and Carol and all of us.
Mhm.
So, and what's good for our clients is good for us, good for our families. I teach it to new agents because they have to start. I want them to start thinking from the outset on all of these elements.
I have a question.
Yeah, go ahead.
So, Ruth, hi, this is Valerie. I'm here in the San Jose office with Julie. I
Hi,
actually
Valerie.
that called me this week, and she has a rental property she's owned for about 10 years. The tenants have just given her notice.
Mm-hmm.
She's trying to make a decision about what to do. So capital gains would be pretty significant over that period of time. And she's trying to understand what her options were. So I think one of the things she had in mind was potentially to go ahead and purchase a property that would eventually become her retirement home, but purchase it now and rent it out. But she does want to take some cash out. And is there any way for her to take cash that won't act as boot, I guess is what I'm trying to say. Is there any way for her? No. So anything that comes.
Oh, well, let me, no.
Yeah.
Let me correct myself. Have her refinance the home and pull cash out tax-free.
Oh, yeah, and I'm not sure if they have a mortgage or not on it, but I can.
Yeah, but that's how you pull it out tax-free. You know what I'm saying?
So she would refinance before she sells it.
Mm-hmm. Or she can buy the new replacement property and then refinance and pull cash out. So doing the refi after the exchange is better than doing it right before. You know what I mean? It's so don't do the loan and then sell the property. Do it, buy the replacement, refinance, pull cash out, just like the tick.
Yeah,
But don't start any loan process until after she owns it. That's why we wait 2 weeks on the tick, because the IRS doesn't like you creating loan proceeds before you even own the property.
Yeah, thank you so much. Thank you.
Mm-hmm.
I may send her to you to talk with you about that. So her name's Vivian Nguyen.
Okay.
I'll let her know to let you know that I referred it. Vivian and last name Nguyen.
Okay.
Thank you.
Yeah, great. Now the minimum price, just so you guys know, for the liquid 1031 is 600,000. Now here in California, I really don't worry about it, but I talk to people all over the US. I have one guy in Tennessee. It says, well, my property is only worth 400,000. So I said, do you have another one you want to sell? He goes, yeah. I said, so let's combine them within the 6-month period under the exchange rules, get them lumped together to go buy the tick and get your money. So that's what he's doing. But usually here we don't run into that problem.
Oh my gosh, I gotta go.
Awesome. All right. Thank you. And thank you, Tammy and Carol. Carol Sue, how are you? I see you there. Thank you for being here. Thank you so much, Ruth, for your time. This has been so informative. I'm looking forward to interacting more so coming soon. And anything else? Skip, you got anything else?
Nope.
All right.
Hi, I'm so
We had it.
sorry. I am here.
No worries.
I couldn't find the button to turn my voice on. Thank you, Ruth. Very informative. And Julie, you're just the best for putting all this together.
Aw, thanks. And I didn't even have to pay you for that.
Never. If I could only learn how to charge for what I do.
Right.
All righty, everybody. My head is just spinning right now, so I totally appreciate it, Ruth. And,
Let me say one last thing.
oh, go ahead, go
Ruth-
ahead.
Ruth, I just want to say one thing. This is Valerie again. I've probably been to 10 presentations on 1031 exchanges and kind of felt like I knew everything about them, to be honest with you. And your presentation was awesome. So you presented levels of detail and nuances that I have never heard any other presenter that I've gone to over the last 5 years cover. So I just want to tell you that how much value that adds to us as agents and gives us so much confidence to be able to work with someone like you. So thank you so much.
Awesome. Thank you, Valerie. Very nice.
I echo that and completely concur because there were a couple of things in your strategy mix that are completely new. And yes, we hear a lot about 1031s, especially in our little local market here. You can imagine. So we know everybody, right?
Well, and I want to let you guys know, I've been doing exchanges since 1988, right? And back then, people treated the strategy like they do everything else today. Are you sure? Does the IRS recognize this? And remember, exchanges have been done since 1921 and never got their code till 1979. So there's other things out there that work that are kind of like in that same process, waiting for someone to sue the IRS and win.
Yeah. We learned something new every day. I
Yeah,
totally
sure do.
appreciate it.
I'm learning every day myself.
Right?
So yes, I can imagine.
Exactly. All righty, everybody. Thank you so much for your time, Ruth. And thank you for everybody for your time as well.
Next week we have
Next week, we have Wanda Kidd, who actually Ruth was
recommended.
recommended with Wanda, and I spoke with Wanda yesterday. I'm really excited about what she's going to share with us because she has a lot of insight and in financial readiness, credit readiness, and credit repair. And I put a little pin in her ear to create a talk about the 55 and over demographic. So she's going to be working on that and bring us the information. So I'm so excited about that for next week. All right,
I
everybody.
have to try and join that one so I can hear her. So that'd be great.
Yeah, we'll have her recorded for sure.
All right.
Bye-bye.
All right.
Have a
Thank
wonderful
you, everybody.
Thank you.
Have a great week.
Okay.